Okay. And the live screen has started. Good morning, good morning, good morning, everyone. Good morning, Carly.
Good morning, good
We are
afternoon,
here.
whatever it is at this time.
That's so true. It is the afternoon. Started. Good morning, good morning, good morning. Do you hear feedback?
Mhm.
Good morning, Carly.
Good morning, good morning.
Go to your YouTube. Go click right here.
That's so true.
Mute.
It is the afternoon.
Now go back to your thing. Minimize.
Okay, there we go. All right, guys. So we are here again at our home buying seminar. We're doing this week in and week out. We will be coming with some new dates for you guys, as well as some, well, I should say new days that we're trying to try out to help those people out who aren't able to meet with us on Friday afternoons. We understand that people work on different schedules. And so with getting some feedback, we were like, okay, let's see how we can work this in for evenings for those people who aren't able to come in the daytime. So we're working on something like that for you guys in the background. And the day we're looking at are Thursdays. Okay. So hopefully that can better help more people to come on to the lives and come into the meetings with us. And so to start, my name is Keneshia Haye. I am a Jacksonville real estate broker here. And I am joined with my friend Carly McLeod. She is a mortgage lender. Go ahead, Carly, you can introduce
I am a
yourself.
local mortgage loan officer here in Jacksonville. I'm licensed in Florida, Georgia, Virginia, and North Carolina.
Mhm.
And we love to do regular home buyers, first time home buyers, whoever is into the market, we're here to help them.
All of that good stuff, all of that good stuff.
Uh-huh.
And so we're going to go through the whole home buying process as we do week in and week out. But Carly, I wanted to try something a little bit different today as once we get done and everything. And we could talk about maybe a scenario. What is going on with buyers? Like have you had a scenario where you've had to take a while with the client to get them qualified? And how was that process? What are some of the things that you're seeing that people have to work on more so than other things? All right.
Yeah. Yeah,
So we
exactly.
can
You want to
touch
talk about
on
that
that.
now?
Let's do the
Regular.
slides, and then from there we can touch on some topics like that. Let's see what the market is looking like for us with buyers.
Okay.
And let's just talk about that at the end, okay?
Okay.
All righty. I'm going to go ahead and share my screen and get this PowerPoint up for us. Okay. And guys, this, like I say, this is our first time home buyer seminar. We don't like to call it first time because we want to help anyone. Let me see how to make this thing one whole screen. Horace?
Bottom right corner.
Bottom right of my computer itself, or
screen.
okay, bam, there it is. I am so computer savvy, y'all. Anyways, guys, so it's our first time home buyer seminar. I've already introduced myself and my co-host Carly McLeod. Okay, and it's not moving for me. There it is. All righty. And so if we were having this in a classroom setting, I would definitely ask everyone, what is your name? I like to do icebreakers. I like everyone in the class to let us know, hey, what is your name? What is the purpose of you showing up today? And if you guys are on live, or if you're on the Zoom and you want to just put a response there, let us know what's your name? What is the biggest thing that you want to take away or learn today? And what is a pain point that you have been feeling if you've already started the process or if you've already heard some myths about the home buying process? What are some of those things that you would like us to touch on for you, okay? And we're going to have a question and answer session at the end. So you could just hold your questions or write them in the chat and we'll get to them, right? So you are ready to buy a house, and this should be the most exciting time for you. It should not be stressful. And I would say it till I'm blue in the face, we're going to do a pre-approval and not a pre-qualification, because a lot of the stress people don't understand. It's not you going out looking at houses. That's the fun part, right? Looking and opening up these different doors, and you seeing these high ceilings or you seeing the low ceilings and like, that's too low for me. The kitchen isn't wide enough. so on and so forth. That's the fun part, right? But then it's like, once you found the house and you're happy with this house, and then now you're going through the process only to hear you don't qualify. That's a crusher to anyone. So therefore, I like to get my buyers pre-approved versus pre-qualified in the process. So right here, you see pre-qualification. That's traditionally what people normally used to do, you know, pre 2010, I would say, or no, you know, when we had that big old crash, people were doing a lot of pre-qualifications, which was 2006, 7, 8 time frame. And that pre-qualification, Joe, Bob, Jim could have came into the loan office and said, hey, girl, I'm a millionaire. I make this and I make that, and I don't have any debt, and boom, a loan was given to them. Nowadays, we like to do the pre-approval where your income is being checked, your debt is being checked, and that loan officer is able to let you know that you are truly pre-approved. And when we get to the end of the process, you're not upset or crushed. Okay. And so you will meet with me, your real estate agent. I'll definitely get you with a loan officer, because that's my first step, guys, is to get you with the loan officer. We need to know how much money you're able to afford to purchase a house, right? So we're not out here looking at houses that you can't afford and out of your price range, right? Once we find that house, guys, we're going to go ahead and make the offer, right? What I will do is call a CMA. It's a market analysis of that whole neighborhood to see the recently sold homes in that area. Traditionally, that's what the appraiser will use when he's coming out, or she coming out to appraise a home, is to look at the recently sold homes in the area to go ahead and get you a good market analysis. Now, I am not a licensed appraiser, so my value that I come to are estimates, okay? Because I am not a licensed appraiser. Nevertheless, we get to a price for you. We write up that offer for you. In that offer, guys, I want you to, I got to touch on some in-transaction fees that we're going to write into the offer, which is the earnest money, is one of the things that goes into the contract. And traditionally in this area, we are seeing the binder or earnest money, some people call it, around 1,000 to 1% of whatever that sales price is, right? So with that being said, with your earnest money that'll go into the contract, the inspections that you see right here, these aren't written into the contract. However, these are some other out-of-pocket expenses once we go under contract that you will have. The appraiser is another thing that won't go inside of the contract, but that is another cost that you will have when you're purchasing a home, okay? And I want to go back to the previous already. And so the earnest money, we'll add that in there. Once we get a bona fide, solidified contract, and that's where you, the buyer, and the seller, you have reached an agreement in your negotiation. Once we're there, you have the contract has different dates in it that we must adhere to. For instance, the earnest money, the binder, it must be turned in according to what the contracts say. And traditionally, we've had 3 days that they negotiate and agree on, 3 days to have that earnest money turned in. If you're local, I will advise you to go ahead to the title company and turn that in. If you're not local, you have a couple options. You can either mail that binder in, or you can get with the title company and they'll allow you to wire transfer that binder in, right? And I like to let people know that binder is not money that's lost. That is your money. However, the binder is you telling the seller, I am serious, seller. Take your house off the market for me. I'm going to do my due diligence, and your due diligence is your inspection. And in the event, if me, the buyer, defaults on this deal, meaning that I wake up one morning and I'm like, I don't feel like I like this house no more. It's blue and I don't like blue today. In the event if you just cancel just to cancel, then guys, the seller would keep that binder money. All right. So as we move on through the transaction, like I said on the other screen, the other factors is your inspections. The home inspection is not required. Okay. Their home inspection is not required. However, guys, you've never lived in this home, so I would always highly suggest that you get the home inspection done. That is a cost of yours because you are hiring a home inspector to come out and inspect the home. And honestly, I would say you should be glad to pay these people because people have been saved from a lot of costly repairs because they have done these home inspections prior to closing on a property. The other inspections, the WDO, which is the pest inspection, the 4-point inspection, as well as the wind mitigation, those are required inspections. Your WDO is required by your lender. The 4-point and the wind mitigations are all required by your insurance company. Okay. The appraisal, that your lender will order that'll be later on in the process. I like to tell people, let's wait until after the inspection period, because during that inspection period, depending on how many days you and the seller have negotiated for you to have this inspection window, it's also your due diligence window. That is that window that you can check on whatever you need to check on, as well as if you feel like, hey, we cannot come to an agreement with some of the items that I find defaulted in the inspection report, you can terminate the contract during that inspection window. Okay. So I like to tell people, hey, wait to order that appraisal after that inspection window, because that will be money that's gone and you can't get back in the event that you and the seller can't come to an agreement with the inspections. Okay. Moving right along in the process, guys, once we finish with the appraisal, and if the appraisal comes back good, meaning at value or below the value, then we're going to move on to what's called the underwriter. And the great part about you being pre-approved already, the underwriter has already been in your file, right? So that eliminates so much of the headaches. You're not wondering, hey, did I make enough on my last paycheck? Are they going to gig me and say I don't make enough? You don't have those headaches. The underwriter have already checked those financials. They've seen that you were fit and they issued you that pre-approval. What they're checking now is the other things. Now that we have a home, now that you've gotten an appraisal done, they're checking all these other things. And then hopefully you've not went out and purchased anything new or done nothing different to your credit, and they won't discover anything new on your credit reports. Therefore, the loan would go ahead through to closing, right? And you're going to get those final good words, you're clear to close from your lender, and we go on to the title company and get all your documents signed. That way you can get the keys to your new home. One thing before I get off here, Carly, I want to let people know, when you're showing up to the title company to sign your documents, make sure your ID reflects what's on the contract. Make sure your ID is up to date. I understand, like for instance, I just had some clients the other day, they recently got married right before closing. So it was very imperative of them to go ahead and either leave the license where it is, because we had the contract already written with the name, or you will need to go ahead and update that contract. And then from there, we'll need to update your license. And then from there, we'll need to update the contract to match your new names or things like that. But the best thing is to talk with your loan officer, talk with your real estate agent before you even do something. If you are thinking about getting married, let us know. That way we can, check the boxes and make sure everything is good to go. Because I've had one scenario that we got into the closing table, and when I say we had to jump through hoops, the person had to leave the closing table, get to the DMV to go get the new driver's license. And it's just that serious. And so it halts the whole process.
Yeah. I believe it.
Yeah, but go ahead, Carly. You could go ahead and take it over.
Okay, cool. Do I need to, what do I have to do? Take over control or whatever?
Yeah, okay. So let me stop my share here. Okay. And then you get to ask for the control, or let me see if I just give it to you. I can make you a host.
Okay.
All right.
Okay.
Okay.
Cool.
There it is.
Cool. Will you put the slide back up?
Mm-hmm. But if I put the slide back up, it's going to be my screen.
Oh, do I have to put it up?
Or I can keep the host and then I could just slide through for it.
That's
okay.
Easy. Yeah, let's do that.
Let's do that then, hon. Let's do that. Okay. And I'll go back to sharing my screen with it. Okay. All righty.
Okay. Yep. I see it. Okay, cool. So yeah, so what Kenesia's already kind of gone over some of the things here. So let's keep going. Equity is a big thing that we always want to talk about. And people ask often what equity is. So equity is basically your ownership interest in the home. And what that means is the value of the home versus what you owe on it. So obviously, if you have a 30-year mortgage, by the end of 30 years, you own 100% equity in the home. And when you get into the home, you're automatically building equity because that's what your down payment is. So a lot of these things people view as just like out-of-pocket costs, like your down payment and stuff like that. Down payment is paying down the price of your home. So that's automatic equity that you build in your home. And every time that you make a payment, you're paying equity into your home that you keep. That's your money. That's the difference between, renting a home and owning a home. That equity is something that is yours that you can borrow against in the future. You can take out something called a HELOC, which is a home equity line of credit. It's like a credit card. And your home also just naturally goes up in value too. And in this market, we're expecting, more rate cuts by the end of the year. We expect the values of home to rise with that. So that's automatically your home just being worth more money just because it exists and it's in this market and you own it. So that's a huge thing for that you gain as being a homeowner. This is the way that people build wealth in this country. So I'll click through here again.
Okay.
And let's see, this is just showing national equity in the home. So, we're down here in Florida and you see the average equity that we have in the home, that's in that largest category here. So in the state of Florida, it's a good place to be for that reason. You see how much equity we build in these homes. Let's keep going.
Okay.
What else we got here? So when you come to me, Keneshia is the person that goes out and finds you the house. I am the person that will tell you what you can and can't afford and if we can do a loan for you. So that's what we're doing when you're sending me an application and when you're sending me your financial documents, because we'll tell you what's the max amount of home that you can afford, how much money will you need to put down and your closing costs, and we'll be the people reviewing all of your documents. We will be reviewing things like your pay stubs, your taxes, bank statements, things like that. So you just have to keep in mind, it can feel invasive, but we're not looking at these numbers with anything other than wanting to get you approved. And trust me, as opposed to buying anything in any other industry, we are all on the same team here. I want you to buy this home.
Yeah.
Keneshia wants you to buy this home. You want to buy this home. We are all on the same team. So you can rest assured that I'm not picking through these things with the intent of cutting down or anything like that. I want to make sure that what I tell you can go out shopping for, you can actually afford and we can get through underwriting.
Exactly.
So we are all going towards the same goal. As opposed to like going to like a cosmetic store and they just want you to buy their product because it helps them. It's like, does it help them? Well, I don't know, but we all want the same thing. So let's keep going here. So what else do we have to talk about? Lots of things. Click through. There we go. So your credit score. This is a big one. We'll talk about minimum credit scores too, but we have to be cognizant of the fact that what you see on your Credit Karma or what you see through, say, your credit card statements, because I know a lot of credit cards will show you your credit scores and stuff like that. Those things can tend to be different than what we see when we pull your credit as a mortgage lender. You just have to keep in mind, you are buying a multi-$100,000 property. And if you were to lend that money, you would want to be pretty darn sure that the person paid their bills, had decent enough credit that you were fairly certain that they would repay their debts. Even somebody who has an 800 credit score could default on their debt, but that's a track record of seeing what you do and don't do normally. But even if you're not there yet, even if your credit score is not there yet, I will advise we can make you a credit plan. And sometimes these credit plans can get you to where you need to be immediately. Sometimes you may need 6 months to a year. So, if you think you just don't qualify, I say go ahead and let's talk. Let's do a soft pull on your credit so it doesn't hurt it. And let's set up a plan to get you where you need to be, because credit is silly. Things that you think help don't always help. Things that you don't think will hurt do hurt. It's a weird thing. Let's not shoot in the dark. Let's build a plan that we know will work, and you move forward with that plan. So that way we know we're on track to getting you where you need to be, even if it's not immediate, at least we're going to get you there in whatever the time the plan takes, 1 month, 6 months, 12 months, whatever it is.
I agree.
Okay. Let's keep going here. Getting pre-approved. So this is a thing that Keneshia was mentioning earlier. So when there's a difference between getting pre-qualified and getting pre-approved, they sound
Mhm.
similar. Some people use them interchangeably, but I'll tell you what the actual difference is. So I am somebody as a loan officer that will get you pre-qualified. So
Mhm.
I will look through all of this documentation. I will pull your credit. I will be looking at your pay stubs and your bank statements and all that kind of stuff. And I will tell you, in my opinion, what you qualify for. Now,
Mhm.
ultimately, the gatekeeper in this whole process is the underwriter, right? They are the gatekeeper. They are the people that ultimately will say, yes, I know. Sometimes you want to strangle them, but they are ultimately the people saying yes or no to whether your loan gets approved or not. So what we can do, even before you are under contract on a property, you don't have to have, something specific in mind. I can send you through to them and have them review your file. It usually takes a couple days. And they can tell you if there are any skeletons hiding in the closet that are going to deter you from buying things that, or maybe it's just a matter of switching your loan amount. Maybe it's a matter of switching the loan program, which we'll talk about.
That's so true.
It could just be something as simple as, hey, we need to course correct here a little bit, and this is what you need to do to get approved. So we know that immediately. And also, when Keneshia goes to submit an offer for you, if it says that an underwriter has already reviewed your file and you're good to go, much easier for her to get your offer accepted.
Yes.
You sort of take priority over the people who don't have that underwriter approval, because it takes the risk away from that seller saying, oh, I know they've already been reviewed, like, by the ultimate gatekeeper. So I know that they're good to go. Because then from that point, the only thing that needs to be approved is the home itself. You as a buyer are good, and then the home itself will get approved, and then you're good to go. You're at the closing table.
Yeah.
That's a huge difference. So let's keep going here.
Okay.
So there are 4 major types of loans that we have. There is conventional, then there's FHA, VA, and USDA. Those 3 are government loans. Conventional is considered kind of like the gold standard. Usually a conventional is a preferred loan option, and typically anytime you're going to buy a home, they will accept conventional. You'll see cash and conventional. FHA, VA, USDA are sometimes, not always, accepted as widely as conventional, but they also have their points that are awesome about them. So that's what we'll talk about here. So let's go and talk about what's good and bad about all these. So conventional, down payment is a big thing that people always want to know about. So if you're a first-time home buyer on conventional, it's 3%, right? If you're an FHA buyer, it's 3.5%, and then VA and USDA can be as low as 0% down. Now, when you're talking about down payment and closing costs, a lot of times people think they mean the same thing, and they're similar, but let me break those apart for you, because they do seem like they mean the same thing. So a down payment is a portion of your closing costs. Okay. So you have the down payment. Sometimes you have no down payment. Like we said, if you're a military, you may have no down payment, but you'll still have closing costs. So closing costs are your down payment plus our fees as the lender, plus what's called your escrows, which is basically a holding account that holds your taxes and insurance for the year that they just pull from every month, and then they replenish it every year. And then anything that title charges you, plus appraisals, things like that. So all the cost of doing the loan itself. So your down payment is a portion of your closing costs. I hope that makes sense. Let's keep going here.
All right.
Let's go. So credit score. So we talked about how mortgage has minimum credit score. So conventional, like we said, a bit of a gold standard. That one you have to have a minimum 620 credit score. You see, what's really nice about FHA and VA is that they go a bit lower. Again, these are government options. So FHA and VA go as low as 580. So you have a little bit more room there if your credit is not where you want it to be. That can take you a little bit lower. And then USDA is a little bit more of a strict program. USDA is for, as far as area, a large portion of the country, but it has to be a sort of rural area. So even though a lot of the country is rural, it's, the cities are area-wise, small pockets here and there. But if you're in a city like Jacksonville, you won't qualify for anything USDA because you're going to have to go out to like Macclenny or, Callahan, like places like that to be able to use a USDA loan. But the FHA is a great option because it will let you go down lower with your credit score. FHA will let you go higher with your debt to income ratio, so you can come to the table with more debt that you're carrying. And that's one of the great things about it. So sometimes an FHA is a better option for you. Just because conventional might typically be preferred, FHA can also be a great option.
Question for you, real quick, Carly. Is some of these loans, right, you're able to get a certain amount of concessions from a seller, right?
Yes. Yeah. So that's a great question. And we're in a market where when we were talking about closing costs and down payment and all that stuff, you might be saying like, that's a ton of money. How do I get all that money? Well, the good news is that these programs all allow certain amounts of seller credit, which is basically the seller accepting less at closing so that you can have that credit to pay towards your closing costs. Basically the seller paying for your closing costs. Right. So that's another great thing about an FHA loan, is that you can go up to 6% of the purchase price. So say you have a $300,000 home, what's that, $18,000? $18,000 that FHA can contribute to your closing costs, which is kind of amazing. If I did that math right, I don't even know. I feel like I did that number.
It's a lot of money.
It's a lot of money. Conventional is also great, but they're going to cap you out at 3%, half of what FHA will allow, and VA will go up to 4%, I believe.
Okay.
So
FHA is the highest.
FHA is the highest, and their highest. You can't do second homes and investment properties on FHA. So if you go that route, you have to go conventional, but conventional will let you go up that high on certain options. If you put, I don't want to bog people down with things, but if you put more down, you can get more seller credit, basically, usually.
Right. Okay.
Okay, let's keep going. That's a good question though. Because seller credit is huge. So speaking of that, speaking of getting help with your down payment, especially here in Florida, we have, Florida Housing does all kinds of really good down payment assistance programs, is what we call them, DPAs. And they can get you minimum $10,000 towards your closing costs and down payment. Hometown Heroes is now going back and forth because it's out of funds, but then whatever loans get canceled, they'll go back in the pot. So sometimes you can grab them. I got one on Tuesday. It was amazing.
Wow.
Yeah, you just never know. It just depends on if it falls out in the time that you can grab it in time. It's just, but even when that's not available, Florida Housing still has $10,000 available at all times. So what you get then is you just have to have a 640 credit score. So it's a little bit higher than a loan program would traditionally have. A 640 credit score. You have to be full-time, and there are income limits as well as home price limits. So as long as you stay under those, and they're pretty generous, and the interest rates on these are actually usually pretty good. It's a great way to get 10,000. So imagine you get, and there's a cat behind me, you get 10,000 from Florida Housing to pay for your down payment. Keneshia gets you another, let's say minimum 3%, because that's the least on conventional. And now you've got all of your closing costs covered between the two. Exactly. So it's possible to come to the table with nothing, especially if you're a veteran that has no down payment to begin with. Those people are really easy to get to the closing table with absolutely nothing.
Absolutely nothing. And let me ask you a question about FHA. This just came to mind.
Yeah.
With the FHA having that down payment, right, are we able to, let's say I was able to negotiate a good amount, 6% worth of closing costs, right? Are we able to use some of that closing costs towards their down payment?
Yeah. That's a question. It's funny. Somebody else asked me that recently too, and they were shocked. They thought, no, you can't use down payment assistance towards the down payment itself. It's like, it's called down payment assistance.
Stop it. At least I asked about the closing costs. I was asking.
Yeah, it's all of it though. It goes to all of it. Okay. So even when you have, say your down payment is $10,000 and you have another 10 in closing costs. Yeah. If you got 6%, you get all of that. Wow. So it covers all of that and all of it that you can't. So basically we just look at it as like your total is $20,000 and you got 18 or whatever it is. So now that covers the you have 2,000 remaining, covers that 18. But yeah, that's a great question. So, and the only thing that I will say, just so everybody's aware, these programs are usually not, this one specifically is not, but most programs across the country, if you're in another state, these are not gifts. These are not grants, so to say. So they are money that will be required to be repaid at some point. Typically, these are programs that just are second mortgages with no payment on it, no nothing. You don't even have to think about them until you know you're going to sell the home. So when you know you're going to sell the home, it's a big one to remember that it takes effect when you're refinancing, because we're in a market where a lot of people might refinance in the next couple years. If you turn the home into an investment property, an Airbnb, a long-term rental, you know, whatever the case may be, all of those things would cause whatever amount of money you got towards closing costs to have to be repaid. And typically it's just going to take it out of whatever equity you have available in the home, which we talked about earlier. So if you were expecting to get $100,000 off the sale of your home, now you're only getting 90, for example, because it repays that. So they call it a pay it forward type of thing. So it will get you into the house, it'll get you out of renting and throwing all of your money away, and it will get you, you know, in the door and starting this process. But at some point you have to give that money back, and now another person can use that money to get into their home.
I like the way you use that, Carly.
Yeah.
Pay it forward. You
That's
use
what it is
right now to get your house. You're building equity in that property as you're living in that house. And now when you're moving along, because now you've gained all this equity, it shouldn't be a problem for you to now put that money back in the pot. And now someone who's in the position that you were in years ago can now be able to use that money to go on. Okay.
Yeah. Exactly. And sometimes you don't even need to think about it. It's like your home naturally went up in value. So, you know, it can kind of cancel out to a certain extent. Like, yeah, your home went up in value $10,000. You owe $10,000. Well, you just broke even. So
yeah,
you're good.
Exactly.
Okay. So last couple of things here, the do's and don'ts of mortgage. So some of these will feel intuitive and some of them won't. So, one that may not feel intuitive, and it's so funny, I just talked to somebody recently who's like, I have about $15,000 in money saved, but it's not in a bank. And so what I advised that person was, this money has to get in a bank. So we can't take cash at closing. They will not accept cash. And any money that we see on a bank statement, if it's a large deposit like that, basically what we consider large is over 50% of your monthly income. So if you earn, let's say $5,000 a month, anything over $2,500, we're going to have to know where that came from. So what that, if you know why it is, it's because of people that do illegal things and get money in ways they should not be getting money. And they just won't allow that to happen. The way that you get around that, if you are currently in a position where you maybe don't trust a bank, you just prefer to have cash, whatever the case may be, if you get it into the bank and then it's sitting there long enough to where your next bank statement will just show that it exists and it's there, and we don't see that deposit, we don't ask questions.
That's a great tip.
But if we see the bank statement and it shows a $15,000 deposit and you can't tell us where that came from, you can't prove where that came from. Like if you sold a car, we can prove that. We can see that the bill of sale, we can see that you sold a car, that's where that money came from. If you just have it sitting on our mattress, you can't prove how you got that money, we can't use it.
Yeah, that's laundering.
It's laundry, because the 0.0001% of people that will launder money affects the rest of us.
The rest of us. That's why laws have been written.
Yep, all the time. So just get that money in a bank account, let it sit there for at least a month, and then we can use it. Okay, that's the big thing. But also you can do gift funds. So if you have a family member that it would be willing to gift you money, maybe, you know, a family member passed away. I know that's what happened with me. When I bought a house, my husband's grandparents had passed away and they gave us some money to buy our house. So that was a gift that we received, and you can do that. It's really easy to do, and it helps the process a lot. But that's just an example. Something that I think is a bit more intuitive is do not quit your job. Okay. Don't quit your job. Or if you have a planned job change, it may not be a game ender. It could not be an issue at all. But we need to talk about it first. Okay.
Exactly.
What a lot of people don't realize is, yes, we pull your credit in the beginning. Yes, we check your income in the beginning, but you're not done at that point. So what a lot of people will do is now they're like, okay, been checked, I'm good. They qualified me. we are going to check your income again at the end. We're going to verify with your job that you still work with them, and we're going to pull your credit again. So keep all that in mind when you're going through this process. Don't do anything crazy. Don't take out a bunch of debt. That's my next point. Don't take out a bunch of debt. Don't go buy furniture for your new house. Don't go buy a new car in the meantime. You know, all of these things you have to run by us first. You know, all of these things can be okayed as long as we can look at the numbers and make sure everything still works. But don't do these without letting us know.
Exactly.
You hear my dog?
Yeah.
He's like growling in the background. Yeah, he's very upset about people opening new debt. Yeah. So those are the big no-nos.
Don't do it.
Don't do it. Things that do. Okay, and this is the last thing here. Oh, hey, buddy.
I want you to do this one.
He was asleep. That was like a dream. Yeah. Easy.
Oh.
Hey, come here. Why is he so fussy? Come here. So anyway, last things here. I know we've already talked about this, but be mindful that you are going to have your credit.
Yes.
That can be a soft pull. Like I think I said that before. We can do soft pull so that it doesn't ding your credit. If you go under contract, or if for any reason we are taking you in underwriting to get pre-approved, then you will have to have a hard pull. Be prepared to have, like I said, all your financials. Oh, there you go. Sorry. Be prepared to have all your financials pulled as well. So pay stubs, W-2s, bank statements, tax returns. We may need all of those things in the process.
Question for you, Carly. When you say pay stubs, right? How many pay stubs and how many W-2s? How far back are we going with these?
Yeah. So usually it's 2 years. So now a lot of times with your pay stubs, we may just need your 2 most recent pay stubs, which is normal. If you're just a standard W-2 employee, you don't get any overtime or bonus pay or anything like that, then usually we can just take your most recent pay stubs, and that's all we need. We need more if you're somebody who is self-employed. Obviously they don't have pay stubs, but tax returns will need 2 years. And we will need more if you're somebody whose income is dependent on, let's say, a large amount of overtime. You get a lot of overtime. We need that money to qualify you. Or predominantly sales, if you're anything like that. Like, let's say you're a car salesman, your income is going to vary month to month. So we need usually 2 years of pay stubs, not every single pay stub for 2 years, but a year end for 2022, a year end for 2023, and year 2 most recent, for example. Because those will tell us, W-2s will tell us your final pay, which is great, but those year-end pay stubs lay it all out as to, like, this is how much your base pay was that you earned, this is how much your overtime was that you earned, this is how much your bonus commission is. So that's why we ask for year-end pay stubs. Okay, so usually 2 years. And now we're getting to the point where we're almost at the end of this year. So we're getting to the point where you might just be able to give us your 2023 and then your year-to-date 2024, because we're almost 2 years now with that. But yeah, so have that on your mind. And when we look at all of these things, we're not looking for anything. If we have your bank statements, we're not looking where you spend your money. We don't care where you spend your money. All that we're looking at is mainly the total in these accounts. And then if you have any large deposits, that's all we're looking at. We're not adding up where you spend your money. We don't care. We don't have time
Pizza Hut.
We don't care if you like Chick-fil-A. I love Chick-fil-A. Okay. We're not counting how many times you had Chick-fil-A this month, because I don't care.
Exactly.
Okay? I think people think that, and I understand it feels invasive. But I promise you, we do not have the time to care what you're doing with your money other than what your total is and making sure you don't have a bunch of illicit funds going into your account. So that's all we're about. Another thing that's a huge thing, make your payments on time. Make your payments on time. Obviously, if you don't, it'll negatively impact your credit, which is a huge thing. So, and the better your credit, typically the higher or the lower your interest rate is. So the lower your monthly payment is. So we want that for you. For us, for everybody, we want that for everybody. But make your payments on time. So especially if you have had a mortgage before, a mortgage late on your credit report is a huge deal. Because you're trying to get a mortgage and you're showing us that you don't make your payments on time. So they don't like that. Underwriters hate that. Now, if you've done it before, as long as it's 12 to 24 months in the past, it's usually not a big deal. But, and late I want to clarify, this is my last thing. I want to make sure late is not, it was due on the 1st and I paid it on the 5th. That's not late. They're not going to report that. Nothing that's late is going to report to your credit report until 30 days after it's late. So
Okay.
that's late. So as long as everything is under 30 days late, if you are paying it late, you might get a fee charged to you, but we're not going to see that. So, you know, it's okay to be a few days late and it won't impact your ability to qualify for a mortgage. It's only those 30, 60, 90-day lates that we're going to see, and that could become an issue.
Okay.
So, yeah, I think that's everything.
Yeah. So now we have questions. If we have anyone that had any questions, let me stop the screen sharing. Let me look in the chat and see. Yeah, I don't see any questions right now. But nevertheless, like I was saying, Carly, I wanted to just see clients that's taking a long time. What are we seeing that's going on with them? Is it all credit? Is it the finances, as far as I don't have enough down payment and things like that?
Yeah, I think the biggest thing that takes a while is, I would say two things. I would say one is credit, because anything that you do to your credit report takes 30 days to reflect on your credit report. We have the ability to submit it and have it updated quickly if we need to move quickly.
Okay.
But because that's a cost on our end, we have to pay to have that done, to have your credit report updated. So if you're in a hurry, we'll do that. But if you're not in a hurry, then we would just wait for the stuff. Like if we know we have to wait 6 months to update your credit anyway, 30 days is nothing. So those will update within 30 days. That's a big thing, because again, credit is tricky and people don't always understand how things impact their credit, and they don't realize sometimes that stuff has gone to collections when it has, especially medical stuff. I feel like medical stuff, that happens a lot. But medical stuff is the one exception in the credit world, because I think everybody's kind of aware that cost of medicine in our country is insane, and you're usually not dinged for medical stuff the way that you are for like missing a car payment or missing
so does it count against you at all, the medical?
It'll count against your credit score, because any collection is going to count against your credit score. But when we're looking at your debts and we're saying, okay, you have something in collections and you're not paying it, we have to count a number against you for it. We have to estimate a payment for it. Usually we don't have to do that with medical stuff. So even if you have a bunch of medical stuff in collections, we won't have to count that against you.
Is there anything else like medical, or is it just medical?
No, it's the only other thing. Well, this is not derogatory credit. Like the collections is obviously like bad credit things, but your student loans is another thing that comes up a lot and can be really tricky, because a lot of student loans are in deferment now. They came out for a little bit and now they're back in deferment. Even if it says that you have a $0 payment and you're deferred till 2025, 2020, whatever it is, you're getting a 30-year loan. And obviously the underwriter knows you're going to start paying those loans at some point. So we are required to estimate a payment to count against you for those as well. So usually it's either a 0.5% to 1% of whatever that student loan is. So if it's, $1,000, that's what, like $5 to $10, something like that, or $10 to $5. They're small like that. But when you have 15 of those, that adds up.
Yeah,
so
it does.
And if you have an existing repayment plan that like say it shows that when I have to estimate your payments, it's $400 worth of payments, but you have a payment plan that says it's only $200 because it's income based, and I can use that payment plan. So I can help you there.
That's good to know.
And other things are closing costs. That's always a big issue, because financiers are so tight in general with most people now that you don't have a spare 5 figures sitting in account that you're not using. So, but that's a quicker fix, because like I said, you can get a gift. Something people don't know about that it becomes really helpful is if you have a 401k. 401k, you can take a loan against yourself and have a plan to repay it. And we don't have to count that against you as a payment. And there's no tax penalty to do so, which is amazing. Yeah. So it usually, like like I had somebody did it recently. They had, I want to say $12,000. You can usually only take out like half or so.
Okay.
But say you have $10,000 in a 401k and you can do a loan against yourself for 5, you will not be penalized for that. Normally, when you take monies out of 401k, it's a 20% penalty.
Right.
No penalty with this. They
What
probably will
makes
charge.
what makes this one so different? Is it because is there a code you're putting in that's saying I'm purchasing a house?
No, it's just that it's a loan against yourself. It's your own money that you're taking out. And you have
Oh.
a plan to pay that back is the important part. Like,
And that's
they'll-
what makes it
Yeah.
that, because you have the plan, that's what makes it no interest. Is it no
Exactly.
interest?
Yeah, because
Oh.
it's your own money that you're borrowing from yourself and you're paying it back.
Oh.
So you're not just taking it out permanently. You're paying $100 a month or whatever it is until that
Exactly.
loan is replaced. So it's your own money and you're going to put it back so they don't penalize you for it. So
Okay, that sounds like an IUL. Like how,
yeah, like a loan to yourself. So it's easy peasy. If you have that, that can be an awesome way to get funds that you didn't know you had access to.
that's awesome.
You don't have to be 62. You can be 35.
Hello. And if you have them funds, that helps out a whole lot. And plus there's no interest. Why wouldn't I borrow from myself then?
Right, exactly. Now you have to pay it back. And I think they do usually charge an upfront fee for it, but it's usually not a crazy fee. It'll be like a couple $100 if you're taking $5,000-$10,000 out. So really it's minimal.
It is minimal.
So that's a great way to go that you may not have known that you could even do. So money tip for the day.
Yeah.
Hello.
That is a great money tip, because I don't think a lot of people know you can borrow from your retirement like that and not even have to
pay it back. Yeah. Like if you get a hardship, I think hardship may even require you to pay the interest on it. Like you can take it, but you have to pay interest on it. But
that's better. Because who sets the amount you pay back? You, right?
You get to, because I've done this before, so I know personally that it works. I did this at my old job one time. So you get to pick the frequency and amount that you pay back usually. I'm sure every different 401k works somewhat different, so I don't want to say that for everybody. But for me, I was able to say like, okay, I want to pay $100 a paycheck and pay this back until it's done. So, I'll be done in 2 or 3 years or whatever it is to do this. Usually it can be, I don't remember that there was like a limit. I mean, I'm sure there's a limit. You can't be 10 years, I'm sure, but like 3, 4, 5 years, I think we're all options.
Okay.
So it's a great plan. It's a new one.
Definitely.
Yeah. Is there anything else I can think of that's been a big issue lately? Student loans is a thing. Appraisals in the future could be a thing if we have a lot of competition once rates go down. So,
well, shoot, if rates keep going down, prices is gonna start going up once.
That's exactly what's going to
get
happen.
into the market.
We're afraid that that's what's going to happen. So we always say, if you're able to purchase now,
this is the time.
This is the time, because you can still get seller credit right now, and homes haven't ballooned in costs. And then whenever you're ready to refinance to get a lower rate, you can do that. And a refinance is not new closing costs. I think that's a thing that people don't know. You're not paying a down payment again. You still have closing costs, but the beautiful thing about a refinance is those are just wrapped into your loan amount.
Yeah.
So if it were $10,000 in closing costs that you would have with your refinance, you're not paying that out of pocket again. That's just going to be like you had a loan for $200,000. Now you have a loan for $210,000 and you're refinanced.
Yeah. So, and typically it'd be less because wherever you started your loan at, it should have been paid down a certain amount by this period of time. So it's options. There's options out there, but I like to just inform people and encourage people that home buying is not a tedious and hard process. It's as easy as you want to make it. I just went through the process myself, and the underwriter is not my friend.
No, I know.
Everybody hates the underwriter.
I know.
But I get it though. You're borrowing a significant amount of money, and they want to ensure that you're going to pay that money back. So once you have that mind frame and understand, hey, this is not personal. This is someone that I'm going to, and I'm borrowing hundreds of thousands of dollars from. If you went to a family member and borrowed $20, they own you like when you
right,
that, you know,
right,
versus 200, 300, $400,000.
yeah,
Just keep in mind that they are going to be checking and making sure that you are able and capable to pay that money back. But
right.
the process, I'm like, hey, let's do it. The equity is going to be here in these homes because the house prices are going to go back up.
Yeah, they're going to, and unfortunately, homes in some areas can feel pretty unaffordable, and that's not. I don't think that's going to get any better as we go into the next year or so. So, we are here to run the numbers for you. There's no cost.
Oh, yeah.
There's never a cost to run the numbers for you, you know, and it's no disservice to you either, because we can do a soft pull so it won't hurt your credit. We won't charge you for anything to run your numbers. You just have to be cooperative in the process and send the required documentation, any other things that we might need in the process to get you pre-qualified. And then you have the information you need to move forward. You don't have to move forward. If it's just a year from now, you're wanting to start, you have that. And now you know that you're good to go. So I would say reach out to us and get the process started and let us know what you guys need, honestly.
Definitely. Well, until we meet again, Carly, thank you.
Yes.
Thank you. And thank you all for showing up, regardless if it's today or you find us a couple of days down the line, because this is go ahead and go up on the YouTube. But if you guys have any questions, leave us a comment, leave us a note, ask us, okay?
Yeah.
And we'll touch on it on our next show, our next video, okay? So see you guys here next week, Friday, same time. And then, like I said, we're going to be working on some different days throughout the week for those people who can't make the lunchtime schedule, okay, guys?
Exactly. Okay.
All right.
Bye. Happy Friday.
Happy Friday to you too, love.
Bye.